Okay. Ian, can you break down the liquidity trading volume formula? Good question. Good question. So I have covered this before, but basically nowadays, if you go to most dexes, like One Inch Exchange, if we go to the exchange tab, even same thing with Sushi and Uniswap, they'll tell you the slippage. So, like for example, let's say I want to sell 15 Ethereum and buy idle, right? The slippage on this is 0.26%. I'm sorry, 2.63%. Basically, I would lose this much on the trade. But this is good to know because as you put in larger orders, right? If you're trying to sell 150 Ether to buy idle, you'd lose 21% just on this trade, just by buying because of the slippage, because there's no liquidity here. Same thing if we go to Sushi. Okay, yeah. So let's say we want to swap, same thing, right? Initially 15 ETH, same thing. Price impact is what they use here. On One Inch, they use slippage, which is basically the same thing. You just by making this trade, you would lose 2.8%. If we change this to 150 ETH, right? They don't even let you make this trade on the Sushi swap, right? Because you lose 22%. Actually, what's the max they would let you do? Yeah, so they warn you, right? But the calculation I like to use is for liquidity ratio, taking the 24-hour trading volume and the market cap. This basically tells you what the market thinks now. So looking at Polygon has a trading volume of 417 million in the last 24 hours, which is actually a lot, right? And I just divide this by the market cap. So basically, half of the entire market cap has been traded in 24 hours, which is actually not healthy in my opinion. Basically, 52% of the market cap has been traded. What does that tell you? That tells you a lot of traders, a lot of short-term speculators are in Matic, because it's not healthy for a project to basically be bought and sold, because market cap of all of Matic is 800 million. So basically over 400 million of that has been bought or sold in less than 24 hours, meaning that there are lots of traders in it. People are just riding that trade, lots of speculation, right? Ideally, you want to have a project where there are lots of long-term believers in it. This is typically for early coins that have just launched. So for example, if we go to idle finance, for example, let's compare this, right? So in volume, 635,000 versus market cap of 29 million, right? So let me just do the math on this. Because Matic was basically 52%, idle finance is 2%. So 2% of the market cap. So actually this is very illiquid. So ideally, I would say a good range, this is different for everybody, but for me, a good range is typically minimum 10% of the daily, 10% of the market cap should be traded every day. That means it's a very liquid project. But low cap gem, sometimes you have to kind of sacrifice on that. But in general, though, for me to even get into any project, I look at the 24-hour trading volume and I get 10% of that. So in this case, we have $635,000 in the last 24 hours. 10% of that is basically about $60,000. So I would not put more than 60 grand into any trade order, but ideally probably even just 5%, meaning that basically cut that in half. So basically 30 grand is probably the maximum trade I would make or buy order I would make on this project. So that's kind of how I use that. Bill, any comments in terms of how you kind of manage getting into different projects with different liquidity levels?
You know, Ian, I think you pretty much covered it. The only thing I would say to new people, even though you said it, I would rephrase it. I know the idea of small coins and a huge 10 or 15x return is exciting, but you also have to make sure that whatever money you put in, that you can get it back out again. So looking at things like volume versus total supply is important. It's a way to check yourself so you don't wreck yourself, because we have heard unfortunate stories of people who got in and were not able to get out. So a word to the wise there.
Yeah, absolutely. Like that model. Check yourself before you wreck yourself. And that's how you avoid getting rug pulled, right? Because you want to make sure that whatever you're getting into, as Bill mentioned, is liquid enough for you to get out of it in case of an emergency, right? So, for example, in the pandemic, right, when Trump shut down borders for America and nobody could fly in because of COVID, because that same day, because I keep on saying this story because this is probably the best example. I went to sleep probably around 2 or 3 a.m., woke up around 10 a.m. But basically in less than 12 hours, the market had dropped 40%. When you went to sleep and you wake up first thing in the morning and you check your blockfolio, right, 40% down on all your altcoins. Basically in the blink of an eye. So that's basically when liquidity is needed the most. And if you're in these shitcoins, the liquidity can drop real quick, super quick. So you have to be able to plan ahead and make sure whatever you're getting into is liquid enough for you to get out of it. So it's kind of like that emergency, right? Like break glass, pull out I don't know what, fire extinguisher or axe. You have to make sure that whatever you have, you can get out of it. So that's why I don't really like degen plays, because degen plays are the first thing to dump, where liquidity can go to zero real quick. That's why I haven't really been rug pulled, because the projects and going through all these metrics is designed to help you avoid all these rug pulls, right? Because if you're going into legit projects based on our code reviews, right, that we share with the customers every Tuesday on tokenmetrics.com, if you're getting into solid projects that are liquid and you're managing your risk and you're looking at the liquidity ratio and the trading volume, and you use that to also manage how much money you invest, how can you get rug pulled, right? That's why, like, people who are getting rug pulled, you either invested way too much, didn't look at the liquidity metrics and the trading volume, right? You overextended yourself. You didn't really practice proper risk management, and as a result, you get rug pulled, right? Because, I mean, first of all, if good projects don't rug pull, so that should filter out probably almost all the rug pull scams. And then factoring in the liquidity and being smart with how you go in and planning how you get out, you should not get rug pulled. But anyway, tell us what you think down below.
Token Metrics is a cryptocurrency investment platform that helps users leverage machine learning to become better crypto investors. Our in-depth analysis helps eliminate the emotions of investing, find profitable investment opportunities, and filters out scams. Learn more at tokenmetrics.com.